MBA Research and Curriculum Center and NOCTI have collaborated on this microcredential. This microcredential deals with business structures and consists of 5 targeted skills. This targeted skill explains types of limited liability companies and corporations. According to the U.S. Supreme Court, a corporation is an artificial being, invisible, intangible, and existing only in contemplation of law. Therefore, a corporate entity is independent of its owners and is treated as a person with legal rights, duties, and powers. Separation of the corporation from its owners means that the owners are not liable for the company's actions, and their personal property cannot be taken to pay outstanding debts. Owners are only liable for the amount they invested in the company. A corporation can borrow and lend money, buy and sell goods, make contracts, sue or be sued, and have an unlimited lifespan. Corporate owners are those who purchase shares of stock and become a stockholder or a shareholder. The more shares of stock a person owns, the more control the person has over the business. As a form of business ownership, a corporation is suitable for almost any type of business. It is most often used when the business requires large amounts of capital, such as with airlines or manufacturing. Businesses with uncertain futures, such as new magazine publishers or entertainment ventures, are also well suited to be corporations. In the United States, corporations are in the minority as a form of business ownership, but they generate the majority of sales. The main disadvantage of a corporation is the complex nature of corporations, which brings more government regulation than sole proprietorships or partnerships. Corporations are governed by a board of directors consisting of people, sometimes stockholders, who make decisions about business activities. The company's officers, like the president and chief financial officer, execute their decisions and run the day-to-day aspects of the business. There are several types of corporations. A corporation may be private or public. Private corporations do not sell shares to the public. The shareholders are the owners and operators of the business. Public or C corporations can sell stock to the general public. This type of corporation has more complex government regulation and must provide public information, such as annual financial reports of earnings. An S corporation is taxed as a partnership while offering corporate liability protection to the owners. S corporations are smaller, with no more than 100 shareholders. Nonprofit corporations are mission-specific, such as charitable organizations that provide services to fight cancer. Franchising is another type of business and a popular type of ownership for fast food venues such as Subway or Burger King. The parent company or franchisor owns the trademark, and the franchise or small business owner has the rights to operate using the name, brand, and products. Franchisees bear the cost of a franchise fee, construction, and equipping the business, and then pay a percentage of profit back to the franchisor. Another unique type of business ownership, a hybrid structure, allows owners or members to enjoy the advantages of corporations and either sole proprietorships or partnerships. Depending on the number of owners, a hybrid business can be structured in one of 2 forms: a limited liability partnership, LLP, or a limited liability company, LLC. Members determine how the company is managed and how profits are shared. Characteristics of hybrid business structures can include limited liability in which personal assets cannot be taken to pay company debts, or limited life, Most states require that the company dissolve after a certain amount of time and/or upon the death, retirement, or resignation of an owner. Limited taxation, in which taxes are claimed only on individual members' personal income tax returns, and unlimited owners or partners, whereby hybrid structures may have as many members as desired. Many professional service businesses, such as medical offices, law offices, and accounting firms, are LLPs. This form of ownership protects innocent partners from the malpractice of other partners. For example, other doctors in the office are protected if another doctor in the practice is sued by a patient. LLCs have their own legal identity and are created by filing forms with the state. LLCs are suitable for most types of businesses. They typically only require one owner and no board of directors, but laws vary by state. Many LLCs have at least two owners. Personal assets are protected from potential financial and legal liability with an LLC. Like general partnerships, LLCs should develop detailed agreements or operating agreements specifying each member's role in the company. With several corporate structures available, it is important to choose the one that is compatible with the corporate members. Remember that major considerations are taxation and liability of the company, owners, and partners.